Welcome to the Thursday night class for avoiding a blown portfolio. So I had you guys write questions in the Discord that I did go through and just get a rough idea and like topic summaries to put on this Google document. But mostly what I'm going to be focused on when I talk to you guys about all this kind of stuff that revolves around keeping money for the long term, basically capitalizing on what you've made and not just focused on growing your portfolio, growing your trading account, but focused on paying yourself. And also along with that, being able to size heavier as you make money while the portfolio grows and not just off your confidence level, I would say. So as I go through this, if you guys have any questions while I'm doing it, you can just type them in the Zoom chat area. But I'm basically just going to focus on what I had pre-planned and also answer the questions already typed. So the first thing I'm going to be talking about is basically entering and or selling based off the chart, whether you're looking at Amazon, Tesla, SPX, SPY, everything has a reason as to why it's bouncing, why it's rejecting, and that's all based off the support and resistance, and also just heavy buying and or selling pressure within a zone. So execution and knowing what a chart's doing is going to play a huge role in just perfecting or at least increasing your odds when you trade. So I'm going to pull up the Tesla chart and I'm going to stay on the 4 hour for now and just show you guys an example of low risk, high reward, just to get that started off with the topic as a visual. So when focused on just a simple example right here, support and resistance is massive with price action, since that's the biggest thing that you can see visually. You can actually use those levels or the zone area to predict a pullback after the breakout. So when execution has to be on a relatively good level, a lot of people, when they see a breakout in this area right here, they're focused on the idea, I got to get in before it's too late. Most breakouts have a pullback to the previous rejection area, which is now going to be the support when the price action is above. So if you're focused on historical areas where you've seen the stock reject, where you've seen it hold, that will play a performance role in the present time with the price action. So every breakout, for a better execution standpoint, wait for that pullback and see if it happens to put the odds in your favor more. That's going to help you avoid the aspect of buying in on a push and it pulls back, you're down 20%, 30%, maybe even just a little bit of red, but you oversize because you think the move is going to be massive. Waiting for that pullback will not only save you that emotional stability of like chasing and being down, but it teaches you how to wait for the best possible setups. Even after this one that you take, whether it's a win or lose, it's treating you the way you should with waiting for a setup to come to you and you not forcing a play based off FOMO or just wanting to play to work out with the big returns it could have. So you really want to trust the chart and just understand the bigger picture of like why you're trading. A lot of people, I get the idea of quick money and they want to put in say $400 and make a few thousand back. It's going to all be based off your risk tolerance and how you basically size per position based off your portfolio size. Many people, and I'm going to talk about this a little bit more later, they'll start oversizing after multiple wins back to back just based off the fact of they feel that they're doing this correctly and there's like no loss that's going to happen from it. So when they oversize on that one play, it wipes out all the gains from the previous week possibly, and that can be a huge mental destruction and also make you want to oversize moving forward to try and make the money back that you just lost. A lot of people use the idea of a loss and regret to do a revenge trade or try and get back what they thought they would have had. Every time you do this, you're not only losing money, but you're basically breaking your discipline within yourself. When you make a plan, when you know you should sell at a stop loss at a certain point, everyone has gone through this and or still goes through it. Like everyone has these kind of mess ups every once in a while. Even the best traders, they mess up every once in a while. And it's not the idea that like, oh, they messed up, it's going to keep happening. They're learning from what they did wrong and using that moving forward to avoid again. And that's going to be how they keep more money and not focus on, oh, I just lost yesterday, I have to like look good, make the money back. All they care about is just the plan, the execution on the plan, and letting it work out, and whatever happens, happens. So to avoid major losses, I just touched on most of this, but sizing is going to be very important. If you have, say, a $5,000 portfolio if you can afford to size, say, $1,000 with a 50% loss, your risk right there is going to be $500 before you even buy into the trade. Like, you understand, if I size 1,000, my risk is 50%. You understand the outcome if you follow it. Obviously, if you don't follow it, you could lose more than 500. So the one thing that I tell people, if you want to avoid major losses, it's not the idea of I'm going to size more and just sell sooner for like that quick gain. If I size in 1,000, normally, if I do 2,000, 20% on 2,000 sizing is going to correlate to 40% on 1,000 sizing. So they're trying to basically make up the money in a quicker stance, size and heavier, not realizing just as much as you can make, you can also lose just as quick. So they're not really focused on the downside. Like, the failures in the red trades are all you should focus on when you're determining like what the outcome of this could be. None of the green matters unless that position works out. So I like to tell people, if you want to like avoid that headache or like oversizing, putting too much faith in yourself when you think you may be right and you're wrong, it can be an ego like destroyer half the time. So just sizing properly, there's no ego involved. You're literally just playing your win to loss ratio in trades, how consistent your wins are compared to losses, your risk to reward for your entry points compared to where you sell and or lose the trade when you sell for a loss. All of these things have to be thought about before even entering the trade. If you're prepared like you should be, a lot of things will work out in your favor without even realizing it's going to work out. As you consistently size, you're going to notice you're not having heavier losses. And if you sell when you say you're going to, that's going to take away a lot of that burden of trying to hit 100% in one trade, or I'm not going to sell for 30%. Like, I want to keep holding. There's not much to really feel bad about if you're slowly growing, as long as you are cutting your losses and not oversizing and not selling. One major loss is going to wipe out all that consistency, and that's what you need. So if you go against it one day and it doesn't work out, like I said earlier, losses are going to happen. So if you size too heavy that one time and it's a red trade, it's not going to just make you set back, say, a week or 2 weeks of gains. Your mindset's focused on where you just were, not where you currently are. So you're going to try and basically chase back what you just lost. You're not focused on, I knew I oversized. I have to go back to small sizing, my usual trim at this percent. If I'm down this much, I have to sell. Sometimes all that gets thrown out the window when that money comes in from like an emotional standpoint. Everything about your plan, your setup, what you know is right, you don't want to do, because usually what's right is not going to be the quickest results that you want. And that's one thing you have to be very patient with, and you have to really stand in that to avoid basically blowing the whole portfolio. So many people I know have done that, oversizing, and they don't realize they oversized until, say, they're down 20%, and that's their usual cut when they're sized normally, if they're down 70%, 60%. So like, that's when they start freaking out. They don't want to sell yet. The chart's still holding. You have to understand all that before just blindly entering a trade based off whether it's FOMO or you just think the chart's going to keep going. And this question, I'm going to start just reading the questions down through the Discord. When do you cut losses or average down with a 2-month out swing? So going off like how to avoid the major losses, I'm trying to keep questions in correlation with the topics just to make this flow a little bit better. But you want to understand, before even thinking about averaging down, is your initial position starter, is this your normal sizing? You have to understand that if you size down when you already size normally, you're basically doubling down your position, hoping it works out when you're already wrong from the initial standpoint. So I usually try, if I size my normal amount, I never size down when I size normally. But if I only enter, say, 10 to 20% of my normal position size, I'll average down at like my last resort, as like, if that fails, then I'm going to have to cut and take a loss on this. And then he said, on the 2-month out swings, when you cut your losses, I base that off of my sizing, if that makes sense. If I basically only size in 1 to 2 contracts and my normal size is, say, 5 to 10, 10 to 20, I'll hold those down, because my normal sizing stop loss would be the same as me holding 1 to 2 contracts to go to basically minus 99%. It's the same outcome from a financial standpoint. So I'll let the trade work out, especially when I have 2 months. I can keep that in the red for 2 months, and a possible reversal, as long as the chart holds, that's my reason to keep holding this position. I'm focused on the chart formation and not just like, oh, I have a month left, I'm down 50%. I just want to get my money just in case. If the chart's holding, a whole month of time left could have that impact to put you back in the green, if not more. This person said, when trading weeklies, if you size to take a stop loss at a certain percent, for example, minus 30%, but the chart does not stop you out yet, would it be best to just take the loss once at minus 30% is hit and accept the fact that you failed to trade because of poor entry? So the first part is basically saying, if you size for a position and your mental stop loss is basically minus 30%. So if you size $1,000, you know right away you're only risking $300. If you enter a position like that, and like at the end of the question, he said, would that be a poor entry and a failed trade? Did you enter correctly? Because if you understand the fact that that was a poor entry, maybe you need to reevaluate like how you enter trades and the reasoning. Because usually if you have a bad trade and you review what you did wrong, you'll find like those tweaks you have to make, the readjustments. You're not going to be changing anything. You're just going to be readjusting what you have to do to get that fixed. So if you know your entry was rushed, or if you you took your strategy the way it was, but the drawback was that heavy on the chart and it put you down 30%, try sizing less than the initial amount you size, because then if you're down 30% with sizing less, that's not your actual cut level based off like the dollar sign of the position. Yes, you're still down 30%, but if you size $500 and you're down 30%, you're only down $150. But if you're sized 1,000, you're down $300. So you can basically hold that $500 sizing down 60%, and the chart at that point may have already broke from your standpoint needed to hold the position. So then at that point, you're able to hold longer, you're sizing less. So for a possible outcome that may save you if it goes red back to green, that's what sizing less does for the emotional side. You're not as like quick thinking with, I got to get out before it's too late. Sizing less, you're able to hold, even if the chart has not broke yet, but you're down a decent amount percent wise. Sizing less, you can hold that position. That's a huge idea that most people need to take in. And also trading weeklies, you have to realize the contracts are going to move a lot faster, whether it's 0 DTE, 1 day out expiration, or the week of. Those contracts are going to move faster than a 2 month out or a month out expiration. So I'm going to scroll down to the next one. So the biggest thing that I wanted to include in here, because I feel like everyone at one point has felt this way, when you just have back-to-back wins. Like, it's not the idea of like cockiness or whatever you want to call it, but you feel that like in adrenaline, you're knowing, okay, I've hit basically 8 back-to-back wins. I think I should size heavier. It's just a natural instinct that people have. Like, they trust themselves so much that they're going to increase the odds basically. And that's when, like I talked about earlier, consistent sizing. You have to understand, one heavy oversize with a loss, that risk was not managed. And that's basically not just money loss, but weeks of time lost from that slow growth you had to get to where you were. You basically overcomplicated it and you gave yourself that extra leg room. I can do this. I know I've been trading good. If I risk this much, I can get out a little bit earlier and make about the same amount of money. You don't understand, if you're wrong, risking more in a position, you can lose way more. 20% on regular sizing of 1,000, $200. But if you size 3,000, that 10%, you're down 300 right away. Even a slight rejection against what you need in your direction, you're down quick. Someone just said, I've done that and I've given the money back I made. Everyone does it. Like, it's not something you should avoid, but you have to manage that. If you want to trade after you've already made money, like one thing I try and do, if I'm up 500 on the day, my next position should be less than $500 total, or the total amount 500. That way, if the trade goes like left 100%, at least I'm break even or I still have profit. A lot of people, they like to size, say $1,000, they make 10%, they size another $1,000. If you lose 10% on that next trade, you're basically back to where you just were, not realizing you already made $100. Are you content with that? Realizing that losses happen, that's another huge thing with ego. Losses happen, so you can't just anticipate, like, I'm going to be right again, this is going to be a green trade. If I want to, I'm sized heavier so I can sell at 10% or 20% just to get out. people don't focus on like what could happen at the bad end of the stick. Basically, I'm not right or I'm green, but I don't want to sell yet. Then you go red. Once you see that red on oversizing that you're not used to, you're focused on the money, the percent, and not the idea of the chart is still holding. The chart hasn't broken pattern, so it's not worth selling it until I see more weakness against my entry point. It's very important to consider that. And if you're not very good at holding, or you maybe can't execute correctly, there's nothing wrong with adding extra weeks or an extra month to your expiration date for the contract you're buying. It's going to save you a headache, and contracts move so much slower and in more sync, like a mirrored image of the actual stock chart. So when you're looking at the option chart and the stock chart side by side with more time to it, you're basically trading like shares. It moves the exact same as the stock. So when the stock's still holding, the contract's still holding that same value. There's no theta, there's no heavy IV crush on the contracts. You have time, so it moves in correlation. I'm going to start working to the next question, the Discord. How do you use a small account? So basically going off everything I was saying earlier with consistent sizing, I prefer to size roughly 5 to 10% of my total, like 5 to 10% of my portfolio, basically. So if you have $10,000, I would usually size 500 to 1,000 per position. If you have $1,000, $50 to 100. If you size heavier than that, you just have to understand the more you trade with, the more you can win, but you can also lose. How and where you enter and where you put a stop loss in a trade. So entering for me personally is always based off support and resistance, or just the price action, bounces and rejections. When I'm using these zones off my charting, it gives me that basic, like, I don't want to say a double agreement, but it gives me conviction to enter the trade, because every support and resistance, every price action, candle, they all represent something. Like there's no reason stuff just happens on a chart in the stock. So when we had this heavy rejection here on Apple, or on Tesla, sorry about that, this heavy rejection on Tesla, once we broke above, I'm looking at stocks to see, okay, if we pull back, are we going to hold this reverse of resistance to support? If we pull back to this level, will we hold? So I'm looking to enter with a low risk possibility, because if we don't hold right away, I can sell for a small loss. And if it holds and does what it should, I'm focused on the gap fills to the upside. I'm entering at the bottom with calls. My risk is very, very minimal. This person said, what time frame do you use to enter trades? So when I'm charting, I'm always on the larger frames. I will not usually go below the 30-minute. So I'll stay on the 2-hour, the 4-hour, the daily and the weekly if I want to see the overall picture of the stock from a huge time frame perspective. But when I trade and enter, I know where the zones are based off the larger frames, but I'll watch stocks on the 15, the 30, not often the 5, but every once in a while I will. But once I know the levels and why they're there, I'm using those on the smaller frames, like the 15, to make my execution entries. I want levels charted on the larger, just so I know why they're there on a larger perspective base. So everything correlates. When the stock gets up to this area, if you're on the 5-minute or the 2-minute, you don't really remember what's happened the days before unless you zoom out or go to the larger time frames. I'm not using that often the pre-market and after hours levels, whether it's the high and the low. I'll use that in the correlation if it basically mimics or shows up the same as the levels that I have charted already. What is the checklist before and during each trade? So a checklist that I usually do, and I can type this out real quick. So when I'm doing a checklist, it's nothing crazy. It's just like very simple stuff that I basically pre-predict before entering. So I always want to know what my risk is going to be from a money perspective. The reason I do from a money perspective is because like the account is the main thing you're focused on. Like you trade an account with a specific amount of money. I don't just focus on I'm down $200, I have to get out. It's the idea of if I enter a contract, say at 1.00, which is $100 a contract, I'm focused on my risk is 0.7. which goes into $30 a contract. How many contracts do I want to size if I'm risking $30 per contract? If I size 10 contracts, that's a $300 loss. If I size 2 contracts, that's a $60 loss. That's why I'm figuring out the risk so I can correlate that to how many contracts I want to buy into. So I know right away, okay, I'm size 5 contracts. I know my risk is $150. Am I content with that? If I follow that sell point, am I content with that? A lot of people won't sell at that 0.7. They'll hold it to 0.6, 0.5. So they're risking more than what they just told themselves before they entered the trade. That messes with your mental, like telling yourself you're going to do something, you don't do it. You get like in a repetition with that. You'll always basically say, oh, I'm going to take profit here. You don't take profit. So you want to stand by what you say when you're doing a checklist, when you're doing anything, journaling, figuring out why you're doing stuff the way you are. You have to be honest with yourself and follow through to build that discipline within. And then when I'm in the trade, I'm only focused on like levels. I'm not always focused on the P&L or how much I'm up or down. As long as the chart's holding and my risk that I have preset has not happened yet, I'm only looking at the chart and that's all I'm doing. Like when the levels hit, I'll sell. Or if the stock's hesitant and my mindset is kind of like I wasn't expecting it to hold this long. I thought it'd move up in a few minutes or maybe an hour or so. So I'm going to start cutting my position a little bit and taking a little bit of profit. Or maybe you want to raise your stop loss to break even, and then whatever happens, happens. So you want to understand that from a like broader perspective. Stop losses at break even are fine. It literally makes your trade free. That's one way I try to explain it to people. When you're in a trade up, say 20%, 25%, you haven't trimmed anything, but you put a stop loss at break even, you are guaranteed to not lose any money. So the worst case scenario, it's basically like the trade never happened. And then if you end up trimming, say at 20% and you leave a few contracts, what you just sold with the trim, you're basically locking in 100% of that if you put a stop loss at break even. You can't lose more and you can't make more unless you sell more before that break even stop loss hits. So that's like the main stuff I focus on. Like there's not much I look at outside of like the main charting. The chart is the biggest thing I look at before, during, and after a trade. If the chart's not aligning, I'm not going to enter something because FOMO or I want to make profit on it before it's too late or everyone's talking about it. I wait for the levels, and if the levels never touch, I just don't enter that trade. If the levels do touch and say I'm wrong, it's not like the system or my plan didn't work. It's just that level didn't hold the one time. Like losses happen. You have to understand that. If you size in correlation every time, there's not going to be a reason to be upset when you actually lose a trade. That's the biggest mental block a lot of people have. So when you actually comprehend sizing, the emotional standpoint that like a loss isn't really a loss if you follow the plan. Not much can really take you out of trading because you can't blow your port that way if you're sizing the correct way. None of this, you have $1,000, you size 200 one day and you lose $100. So you size 600 the next day. You can't size 60% of your position just randomly throughout, because if you have one good win, you may want to do it again. Or instead of 600, oh, I want to size 1,000. That consistent sizing, you can't blow a portfolio. It may take a while and it can happen, but if you size 5 to 10% of your port every time and have a relative smart stop loss at, say, for this example, 40, 30%, it's not going to happen in a week that you blow your portfolio. So you have to understand the longevity side of this. You can make trading work and you won't blow the port. You won't lose all your money. But you have to understand it's a slow growing process. If you don't want to lose your money, you have to be willing to accept that you may not make a lot of money that fast. But if you want to risk making quick money, you have to understand you can blow your port in a day, a few hours, or even a week. How do you swing and be sure to put a stop loss? So I'm not going to touch too much on the swings, but it's mostly kind of like the same with entries, support, resistance. I'm focused on the larger frames if I swing, and I want to play 2 to 3 months out time on a contract. That way, if I do enter a position early, but the level is holding, let me pull up an example. If I enter a position early and say the what's it called? It still works out. So say I'm looking at this area as a rejection zone. So I'm looking at getting puts. If I get puts around this area, say the next contest right here, and I have 2 to 3 months of time, this little push above the next day, I wouldn't be scared out of my position because playing 2 to 3 months out, that contract's not going to be down 70, 60% off that move, no matter what stock it is. If you have a lot of time on a contract, moves like this that usually on a weekly time frame for expiration will move 80% on the downside, 70%. Playing 2 to 3 months out, you'll probably get down, I'd say 15, 25%, which you can afford to hold that if you're looking for the bigger move. So when I swing, I'm focused on like that gap fill or that rejection, and I'm putting on time because then if I am wrong right away or it has like that fake breakout to get people to sell scared, I'm focused on the long-term move with that position. He said, does Rippy God use trailing or hard or mental stop loss? So when he trims in profits, he will use a hard stop loss. If he is basically in a position that's like consolidating or taking his time to move, he'll more than likely use a mental stop loss, but have a given like percent to sell at in mind. Like he knows where he's going to get out and he'll just sell market or just right there at that point. He doesn't use trailing from what I know. He'll just raise a stop loss as he's going up in profit. Also, how to select the correct contract once you set levels, whether it's 0 DTE or 1 DTE. So when you're choosing a contract, the biggest thing that I focus on, because this can also impact how to like save your money in your portfolio and not get like risk losing, because it's a smart risk to reward. It's a smart way to look at the position from a sizing light and looking for that bigger move. When you're finding basically the right contract or what's the best opportunity to get in where the risk is small, rewards high, you have to focus on the price action of the stock and the likelihood of a reasonable move to the strike price that you're wanting to get. So it's the idea of, can you afford to play, let me go to a relative stock people know more about, like Apple. Going off this rising wedge, you can understand that when it comes down to support, it usually bounces within 2 to 3 days. So if you understand that, is the move quick enough to move from a 170, 172 a share to 178 area? So you'd want to get a 180 contract premium strike. Is that risk like worth it? Can Apple move that quick? Because the whole point of choosing the right contract is making sure you don't get destroyed by theta, the IV. You don't want to put in money out of hope. It's always better to play at the money, 1 to 2 slots out the money, and not playing like that Hail Mary pass, because you need continuation for those. If it happens, it's going to work out, obviously. But there's always that idea of it's 2 weeks, 2 days left till the expiration. I'm going to get like a 20-point move for a strike price. A stock has to move 20 points to even consider in the money, but I can sell along the way. You're wanting that huge move, and it may not be logical if the stock moves only, let's say, $10 in a week. Like that's the way it moves, at most $10. So you're putting like a logical standpoint on how much does this stock move price per share. If I do get this specific premium strike, could it happen? Like, isn't it reasonable? I get the idea of like the IV push. If the stock moves heavy, you can sell into like the IV push. That's fine, but you have to have that in your system and your plan before making that trade. You have to understand, like if you make this position and it doesn't move as quickly, you can basically lose that entire position on a reject or opposite direction move to what you need. So adding time will play a good role in that, but you have to choose very close to in the money if you play the 0 DTE or play the 1 day out expiration, sometimes even the weekly. One thing that got me confident, Rippy was in Tesla long and enter and took profit when Tesla dumped. After he had took profit, I would have waited for retest to take, and that is how I always lose on the second entry. So execution with confidence right away, and I hear that execution is 80% of trading, which I always fail at. So confidence and execution are insanely important, obviously. Execution is one of the hardest things because a lot of people, when they think of execution, it's usually like my mind's telling me to do it. So I'm going to buy in. Like, oh, I have to get in. I'm going to do it. You're playing a chart. That's one of the hardest things to really comprehend, I feel like, for some people. You're literally buying off a chart. You're selling off a chart. This isn't the idea of like you're telling yourself, oh, this is it. I have to get in. Why are you getting in? Based off what you're thinking or like your emotional standpoint of, I got to get in before it's too late. You're literally looking at candlesticks that move off, like it's like a statistic, like buyers, sellers, support holds historically because that's what people want to rebuy. When it breaks on the upside, the pullback is like the loading zone again. You're literally executing off of what you see. So there's no idea of like your head is telling you, I got to get in quicker, I got to hurry up and buy in. You buy when the chart presents itself. Low risk, high reward. So you're always focused on execution on the chart, not just your emotions are telling you get in. I have to execute on what I'm telling myself. You'll know when to get in if you chart and just wait. I mean, Apple right here is a pretty good example. Obviously, it already happened. I get that. And it didn't actually come down as far as it should have for this buy right here in this area. But seeing the idea of like when it breaks out on the upside, a lot of people end up buying it on the move and a pullback happens. Pushes up, pulls back here, pushes up, pulls back. Focus on that low risk, like that execution of where you wish you would have got in, but you end up chasing. Get it on that second attempt that you have. If you want to chase the breakout, you can, but you have to understand the risk and you have to trim as it moves at the speed it does in more than one case scenario. A lot of people buy too late. They will wait till the middle of the day, and then it has that major pullback. So I'm always focused on execution off the chart. I'm not focused on what I like. Obviously, I hear those thoughts of this is going to keep going. This is going to move another $5. This contract I would have got in, it's up 50%. It's going to go another 400. I have to buy in. Everyone thinks that, but you have to push those thoughts out. You can't let that come into your thought process because you're not going to focus on like your plan. So when you do enter that way, for me, win or lose, when I review that trade, I have nothing to say about it because it wasn't my system, basically. It wasn't my plan. So even when I make money on if you want to call it a successful trade, if I didn't follow my system, I'm not pleased with that trade because what I've back tested, what I know works for me, I just avoided and basically got lucky. I can't do that again because you do it one time, you don't like confront yourself for it or realize you did something you shouldn't have. You're going to do it again without even realizing it. So I always stop stuff that are bad habits right away when it comes to my execution. Execution is very important. How to temper overconfidence when on a winning streak, similarly, how to hold it together after a few losses in a row. So losses and winners, that's one thing that is very, I'd say, interesting when it comes to like the emotional side of it. When people lose, they want to basically make more money. A lot of people are that way. They're on a losing streak. They just want to get it over with, make the money back they lost. Because a lot of people that size correctly and they lose, they understand like this is going to happen. I'm just on a cold streak. Maybe I have to review my losses and figure out what I've done wrong to fix. So they understand this is normal. But a newer trader that has, say, 4 wins back to back, they have a 5th win, a 6th win, and then they're still sizing the same, but they have a loss, then another loss, another loss. That hype of green may have been like them thinking I got this down. This going to keep happening forever. Like my losses are going to be so small. And then having those back-to-back losses, it's kind of like your confidence doesn't just disappear, but you're focused on, I got to get back to what I was just doing. Maybe it's the money amount, or maybe it's just the idea of back-to-back greens. So you start throwing plays out just to hit green on the day. You may have like had a first red trade, but you want to finish green. So you're overplaying stuff now. You're basically forcing setups that you think are good, but they may not be as accurate as they would be if you are basically starting off the day clean, like a clean slate, basically. So when it comes to basically holding off on confidence when you're winning, it's like you can't really fix it. It's just the idea of this is going to happen. Like playing a sport, basketball, football, whatever it is, you're going to like perfect field goal percentage, perfect passing. You're going to have 5-5, 5-for-5, 6-for-6, but you're going to have those mess ups. That's just a part of the game. Same way with trading. You're going to have losses. But if you oversize on those losses that you do have sporadically, those 3 losses are going to outtake, say, 10 wins, or maybe even the whole account. So you have to understand that confidence is nice, but don't let it affect the execution. Just be confident that your execution will lead to like the results that you've already been having. Small port strategies for holding one contract. For example, Tesla today. Can only afford one contract in my portfolio. Don't want to get too far out of the money, but also want to have exposure to Tesla. So sizing one contract, there's no rule I can tell you. Everything with buying and selling is all personal preference, but the way that I do it, if I have one contract, you have to either accept the fact of these 2 bases. If you're up 30%, 20%, whatever it may be, put a stop loss at break even and let the trade work itself out. Because then at that point, you're not like controlling the outcome. It's either it goes up to 50%, 80%, and then you think to yourself, I want to get out right here. Or it's the idea of it pulls back and you're not telling yourself, I don't want to sell it break even. I'm just going to hold this and maybe it will come back to where it was at 30%. The trade is done after that stop loss gets hit. At break even, if it gets hit, you lose no money, you make no money. It's like the trade never happened. If you're up 30% and it goes to 80% and you don't want to sell manually, raise the stop loss to 30% gains and just understand if this hits, I'm only going to make 30% on this trade. Am I content with that? A lot of people like to raise their stop losses, and that's basically their selling point for that last contract. So that's when it's all personal preference as to what you want to do. What are some common mistakes that traders make that can lead them to blowing their portfolios? So I basically talked about all that, but I'll try to summarize it. So the biggest things that blow portfolios, oversizing, which I'm sure everyone has had this issue. I've had it multiple times. Everyone I've tried helping has had it happen. Blowing a port is normal. And if it didn't happen, you educate yourself before trading. You knew I can't risk all this money, so I have to size light to figure this out first. I'm going to size very light just to learn how to do this. That's the way to do it. A lot of people oversize, even experienced traders, they'll oversize because they have to make a lot of money they're used to. Back-to-back red days, they want to make back what they lost. That's one way people blow their portfolios. Sizing down can also be another reason people blow their portfolios. Sizing down is fine, but you have to understand, I say this a lot, and it's probably going to get annoying, but you have to understand the risk you're taking when you size down. If you normally sized on the first entry, sizing down is like taking 2 positions, and you have to realize you're down the same amount when you average down if the stock's not moving. Your average for the contract price comes down, but you're still in the red when you average into another position. So you have to comprehend the fact that I have to enter at the best place. The execution for this ad has to be good because if I do get a nice reversal in my favor, maybe I can sell it break even. A lot of people, when they size down, they don't sell it break even. They'll hold it in the profits. That's fine. But if it doesn't work out, you're basically hoping for a bigger outcome than what you originally thought would happen when you executed the first time. Me personally, I will not average down unless if I'm sized very light. And another reason people blow their ports, if you guys want to say your reasons for why you have or other people you've seen happen, why people blow their portfolios, confidence, overconfidence. Obviously, I already talked about the sizing heavy. And I also want to say like blindly following people. A lot of ideas are out there on social media or just like a friend telling you, or you see a stock that someone's already up 50% and you want to buy into. Having that FOMO or just like following the crowd, that's not who you are as a trader. Like what you know you have to do to trade, you can't allow that temptation to take over your mindset. What are some psychological factors that can contribute to blowing a port? I mean, the biggest things are you always have to win. You don't want to sell for a loss because you may think anything in a red for a sell is like it's wrong, it's horrible, like I'm a failure. Losses happen. You just have to minimize them. What are some resources that traders can use to learn more about risk management and train psychology? There's a lot of good books that you can read, other YouTube channels and other traders you can reach out to. And I mean, reading's one of the biggest ones. And of course, the best thing to learn from is your historical trades or your charting. Go back and see how it worked out. Figure out what you're doing wrong that's making you lose. You're your best teacher, basically. To learn what to do right and what to do wrong is going to be from you and not someone else. Emotions tie into what you're going to be doing. So you can't really teach someone how to trade. It's about you giving them like the blueprint and then you try and like figure out how it works or how it's supposed to look. You're going to mess up and have to rearrange stuff. Everyone's different when it comes to learning a new style of trading or just anything in life, to be honest. I've blown 3 ports, oversizing on both, overconfidence and revenge trading, losing trades off hopium. Being attached to a trade is definitely hard to, I don't want to say overcome, but if you're oversized, that's when it's hard to really let that trade go. Because it has more of like, I don't want to say a burden on you, but it's like more weight on your shoulders you don't want to get rid of. This person said, I feel like I always sell too early. Any psychological tricks that will make me hang on to my positions longer? I'm a smart portfolio, $300 is my daily goal. The biggest trick that I personally use that I've learned from other people that I've seen trade, sizing light. I know it's not the ideal thing to do because the returns aren't good, blah, blah, blah. Just because the returns aren't good doesn't mean it's going to be like hard to follow through with it. The best thing about uh sizing light, your risk is small, just like making money is going to be small. So if you can't accept losing a lot of money, you shouldn't be allowed to accept the fact you can make a lot of money. So sizing light, you're able to hold positions longer. It's like I was saying earlier, and I'll type this here for this area. If I have $1,000 account and I'm sizing, let's say 20%. So I'm sizing $200 and my risk is going to be, let's just say 50%. So when using the same setup for sizing less, let's say, so this is like a normal sizing, you're content risking 200 a position, which is 20%, and then the risk is 50%. So you're risking $100 a trade, which is basically 10% of your portfolio is your quote unquote, like this is my max risk. So imagine the same scenario from up here, but we're going to change around the sizing. Let's say you size 10%, and we're going to make your risk, let's go 80. So your size is only going to be $100. So now at this point, when you're sizing less, you understand right away, I'm not risking as much as I usually do. I'm not sizing as much as I usually do. So I'm putting in $100. Usually my risk is $100. So right away right away, you're not worried about like being down 10%, 20%, 30%, 40%, 50%. You're sized 100. If you do want to end up selling, you already know ahead of time, I'll sell it 80% down. I'll sell for a $80 loss per contract. You're saving money compared to sizing heavier, and you're giving the chart more room to play out. You're giving the chart a chance to actually do stuff sometimes. Exactly, I've oversized and minus 60%. I get your. Why was not scrolling? There we go. I get irrational that will come back and get destroyed. Emotions go away when I size max 10, 15% per trade. Max risk is 5%. As someone who just started learning about trading, how much is ideal to start with considering the risk involved for new traders? So for that question, the first thing, if someone who has been there and actually has done it, they're going to tell you first, only put in what you can afford to lose. You're not risking that whole amount in a trade, but only deposit how much you can afford. And then after that fact, when you know that number, I usually size one contract a position. I'm not sizing into SPX 600 contract. I'm playing stuff that's like 30 to $100 a piece, 30 to $40 a piece, one contract. You can paper trade all you want, and I'm a big supporter of it, but I'm also a big supporter, and you don't feel emotions until you actually touch a real account. You don't feel that adrenaline. You don't feel the fights back and forth with I should buy, I should sell, I should sell here for green. I should hold and keep waiting. When you use a real account for the first time, you don't want to trade like you got this. You want to trade with, I want to see how this works. I want to see how my emotions work out. So you want to size as light as possible. Put in the amount you can afford to lose, but size very light so you can learn and not just lose in the process. And if you do win, if you readjust as you have those losses, you're going to have losses starting off. You may be very hot back-to-back greens. Understand that you can't oversize until you have like months of back testing or just knowing your hit rate. You understand what works best for you. That's when you can really take that leap into sizing a better way or playing more of a risk standpoint. Sometimes when Rippy takes SPX 0 DTE, I automatically check next day's expiration, $20 or $30 out personally. Adding time is always smart. And when you do this, you're saving yourself a headache and also giving the chart room to work out. So playing time is never a bad thing. It's just the idea that people don't like it because why am I adding time to something I know is going to, well, not I know, but I think is going to move. I'm not going to make as much when it does. But you also have to realize you're not going to risk as much when you add time. Your risk is basically, I don't want to say minimized, but it's very low compared to playing the week of or 0 DTE. So playing riskier contracts or less time, you don't want to size heavy unless you understand the risk associated. If you are trying to figure stuff out, you can add time to contracts and learn how to trade better while sizing less, and it moves slower. So you're learning. So you don't just like come into trading or you've been trading for a few months, a few years. Adding time can save you from blowing your portfolio. It will teach you, I would say, a lot more than just making money. I mean, making money is nice, but how many people can actually say they've like made money off what they've made? A lot of people make money, but they lose it just as fast. So avoiding that portfolio to get it to zero, you can't oversize. You can't afford to risk yourself into FOMO or knowing you shouldn't trade a certain way. It's all about perspective and understanding. If I do this the right way, yes, I'll get lucky every once in a while, leaving a runner that goes 500%. But say you just play it safe every day, it's going to be a slow ride up, but you're not going to fail and have to restart. You're going to have slight setbacks, but it's like 3 steps back, 3 steps forward, 1 step back, 2 steps forward, 2 steps back, 3 steps forward. If you just have that consistency, the portfolio is not going anywhere. If you put yourself in low risk possibilities, it's almost impossible to actually blow your portfolio. The only way it's going to happen is risking more than you can afford or not sticking to the plan. So does anyone have any questions they want to throw out there? Any statements or anything? Any questions right now is fine. The mental is honestly probably the biggest thing people just, I don't want to say can't master, but training for the wrong reasons is not going to get you in a position to succeed. Understanding that it's going to be a long process. If you want to do this long term, making money is very easy, but keeping money is the hardest part. And a lot of people, they don't have someone teach them the mental side of trading. All they teach is like, this is how you buy, this is when you sell. But no one understands like that mental stress of you don't trim or you're in the red and you should sell, but you keep holding. Being taught that is all that matters. Can't make money with no money in the portfolio. Exactly. And another thing too that I also want to say, and I think this has helped a few people in the past, treat your portfolio like your savings account or your checking account. Just because you have $2,000 in the savings or checking, you don't go out and just buy stuff. Just because you have $2,000 in your portfolio to trade with doesn't mean you have to trade every single day that $2,000. Say you have $1,000 left of buying power, you don't have to use that rest of the $1,000. Hit one trade and get out. You need a solid gain every day. That's it. Small growth. Don't overtrade. Don't try and use the whole account just because, oh, it's only noon Eastern and I still have basically 3 to 4 hours left of the market being open and I have $1,000 left to use. You can walk away. A 9 to 5, you can't just in 2 hours of being there say, I'm going to go home. You can't do that. In trading, you can, well, you can, but you may get in trouble. But in trading, You decide what you're doing. Like you can literally say, I'm not going to trade today. I got 2,000 in my bank account. I don't want to go spend money on clothes. I'm just going to stay home and relax. You don't have to use that money in your account. You can just not trade, and there's nothing wrong with that either. Are there just a small group of companies slash securities you trade, or do you follow the money and trade the hot stocks that are not penny stocks? So I have basically a mental and also physical list of stocks that I trade or I look at every day. I don't always trade them, but I watch them. And I usually have 1 to 2 stocks from every sector of the market, whether it's the industrial, real estate, technology, communications. Each one of those sectors, I have 1 to 2 stocks that I have on a watch list, and I'll follow what sector is the hottest on the day, or just find like within the sectors what stock has the attention, whether it's the volume, whether it's percent up on the day. I'm going with the hot sectors, not just the hottest stock people are talking about. Like tomorrow, I'm not going to be looking at Tesla because I missed the low risk move. Even if it moves $10 tomorrow, I'm not worried about catching that because it's a high risk for my personal strategy. I don't want to buy into that because if I lose on it, I know exactly why I lost because I knew I shouldn't have done it. So I'll basically just wait, see what's hot on the day, and I'll use these are the sectors right here. Every sector, I have 1 to 2 stocks that I basically look at, and I use those within. I'll use those to find what I have to find. Does anyone else have any questions? Do you feel like this? I don't want to say it was like a, oh, this is going to change the way I trade, but this like help you realize other traders have the same issues. Because I feel like for me, the turning point was hearing just anyone tell me this is why people lose trading. You have to understand that. And then I looked at myself in the mirror and I realized, man, I do this, or man, I do never sell when it goes to zero, and that's why I never win. When you understand what you do wrong and actually like execute to fix that, there's literally nothing stopping you because with trading, you control everything. Obviously, you can't control where the stock is going, but you can control when you buy in on a certain area, when you sell because you're nervous or you just don't want to hold the position anymore. You decide the outcome. Extremely helpful in reinforcing that my issues are common. Emotions stay in check when sizing is correct. My number one problem is emotion, and it's all linked to sizing. I think that's the biggest thing for everyone. Oversizing or undersizing, and you're not pleased with 100% gain, you want more. That's one thing that I deal with when I size light on a swing and I'm up over 100%. I don't want to sell that one contract. And that's one thing I got to fix with myself. Or if I know I can risk this going back to stop loss at zero, or break even, I want to say, I'm fine with that. Emotions it's always gonna be there. It's just when they like come to you, you can't let it affect the way you're gonna execute. Yeah, I wish I bought more Tesla to swing, but I would have oversized if I did. I have no Tesla, man, and I'm not even like upset about it, to be honest. I didn't buy in or anything. But yeah, emotions is, if you can control that, the only thing left is just letting the chart show you when to execute. If you can execute based off the chart and not just you pushing yourself to do it, like the chart hits a level and you're like, I don't even know if I want this, but the chart says to enter here because my level. Same with me, I cashed out when I was up 350. Hey, money's money. Don't ever think selling too early is a bad thing. Securing profits, all that matters. Because a lot of people that may make, let's say $3,000 tomorrow, but the most they've ever made in a day was 200 or 500. Are they going to be able to keep that money when they've never made it that quick before? Are they going to scale up right away? Are they going to withdraw all profits they just hit because a trade like this doesn't happen often? So they have to realize I can't trade this huge account now because I'm used to only $1,000 or $2,000. That's probably the biggest thing. A lot of people that hit big, they don't comprehend the fact that you can make big money, but also lose it just as fast. Sizing comes into play, having confidence in yourself and not just, I can make this happen again, because plays like this are very rare. When they happen, take advantage of it and then pay yourself. Anyone else got a question or anything? I hope I explained this good, or at least gave a different perspective, I guess I could say. This is stuff that I really wish someone would have told me 2 to 3, well, I don't say 2 to 3 years, but I mean, the minute I started stocks, if I would have known this stuff well before, when I finally understood how to manage all this and not just chase the money, let it come to me, everything that I heard for the first time with this changed everything. It didn't happen right away, but as I put that into motion, took a few months to get the groove with it and like how it works and how to actually follow it. So it takes time, but it's worth it. Definitely helpful and great to see as a newer trader. I'm glad this was helpful. Extremely glad. But yeah, if you guys have any questions after I end this, type them in the Discord or reach out to me. If you have any other ideas for future classes that you personally want to be, you want heard about, type that in the Discord as well and let us know. We're trying to give you guys the best content possible. Whether you're watching this as a recap or you're watching it for the first time right now, we're trying to give you guys what you deserve to hear and what you need to hear to make this long-term journey actually work out. It's not always about just showing like we made this much, this was made, the Discord's making a lot of money. We want to help you comprehend how to do it by yourself or just with a group of people. So anything that you need help with, you just got to let us know so we can get a specific topic down, maybe do extra classes if we need to make sure the topic is instilled in you guys. Do you have any yearly memberships? Reach out to Jarvis in the Discord and he'll let you know. I personally am not too sure. Yeah, you're welcome. Always, always. Jarvis knows anything with payments and memberships and subs. So anytime you guys have questions with that, at him in the chat and he'll help you with whatever you need. But yeah, if this is all that we get, oh, here we go. Thank you very much. This is educative. However, for me, I have a lot to learn before my first trade. I'm still studying the material, and when I'm done, I might need personal mentorship, but your coaching is helpful. God bless and more profit, bro. Yeah, God bless, man. End the week strong tomorrow. Don't give back no profits if you're green for anyone that's listening, and be smart. And bro, make sure you always don't be scared to keep learning before you make a trade. And even when you don't feel like you got it, you got to start at some point. Best teacher is really trading, like real money put in, even if it's just like a contract that you find it's worth, like obviously a logical entry. If you play Ford or American Airlines or a cheap stock like that, you can enter right at the money for like at a most $15 a contract. Buy one contract and just play the chart. Try and understand how it moves while risking very minimal money and there's no emotions involved. So as you see how well you do, you can work your way to other stocks, maybe size heavier, and you'll build that confidence before trying to just make money with it. And you learn first is the biggest thing. A lot of people just jump into it and don't learn. But yeah, that's all we got. I will see you guys tomorrow. Charting session will be on Sunday. I hope you guys have a good rest of your night or morning, and let's kill it tomorrow.